All right, everybody, welcome back into Mining Stock Daily. Trevor Hall here with continued coverage from London and the LME week festivities. I am really excited for this one. Once in a while, once or twice a year, we get a chance to sit down with Michael Howell, the king of liquidity, understands all things, and really, Mike, every time you and I chat, I walk away with something. I was like, oh my God, I learned so much. But in about 15 minutes after I leave your office, there's going to be something like, I wish I would have asked him that because you just make me, my mind just kind of cranks away. Capital Wars, how fitting of a title for your business, your institution, and where we are watching everything unfold in what appears to be economic warfare at the headlines of everything. So, my gosh, your plate must be completely full right now.
Well, great to be here, Trevor. Good to see you, as always. We're the plain fact is we're in a capital war. That's it. It's not a kinetic war. It's all about dominance of currencies. Which financial system and which currency is going to survive over the next 50 years? The US is vying with China, we can see that. And they're fighting on all fronts.
Yeah.
It's all about a capital war.
Yeah. So on the cover of it, we're going to call it a trade war. But what's the difference? What is the defining difference between a trade war and a capital war when they all come back to the same thing about leading the world in whatever currency or monetary system is at the forefront?
Well, I think you've just got to remember that if trade flows are important, clearly, but if you look at capital movements are vastly bigger than trade flows, and this is all about movement of money around the world. It's not simply movement of goods. I mean, I'm not saying that movement of goods isn't important, but it's the capital dimension which is really the sort of the major frontier here.
Yeah.
And that's what everyone's fighting on. They're fighting for dominance of currencies, which is going to be the underlying currency that's used in trade and capital movements. Yeah. And I think what you're getting at the moment is two very different systems evolving. You're getting the US system and you're getting the Chinese system. And the Chinese system is a nascent system, but it's chipping away at the dollar block.
Are you at all surprised about them chipping away? It seems like they were trying to chip away for many, many years, but I would say in the last 8 months, it seems like they've made a lot of headway here, a lot of moves.
Well, actually, it's there's a long-standing policy statement by the Chinese. One of their spokesmen on strategic affairs from the PRC, the People's Army, made a statement back in 2015 that the policy of the Chinese authorities was to replace the dominance of the US dollar certainly in the regional monetary system, but if not the world monetary system. And that is a goal that the Chinese have had. So they are trying to, through different routes, to actually boost the use and the prominence of the Chinese yuan. One of their earlier episodes was the Belt and Road Initiative. That kind of fizzled out under US pressure, and now they're really pushing at other doors. So I think that the latest accumulation of gold by the Chinese authorities, which is really shooting up at a significant pace now, that is something which we've all got to think about. China has allegedly somewhere between, we don't know the real figures, of course, because they're not that transparent, but estimates would suggest somewhere between 3,000 tons, maybe 5,000 tons of gold. But last year they seemingly accumulated another 1,000 tons. Now, if you set that against Fort Knox, which is 8,000 tons, it's going to be 3 to 5 years before China bests the US in terms of gold holdings. And that is, an eye-watering prospect.
Are you saying that a future monetary system, at least out of China, is going to be a gold-backed system and not a fiat currency system?
Well, it will still be a fiat currency system, but it will have gold content. It will not be a gold standard, pure gold standard. That's probably impractical because the Chinese would lose total control of monetary policy. And the one thing that the Chinese will never do is lose control over anything. So I think the fact is that they're going to maintain a fiat system, but it will basically have gold content. And they may well allow selective gold transactions. So, for example, if you're the Saudis and you're selling oil to China, there may be an opportunity for you to exchange directly oil for gold. That's a possibility. That thought has already been expressed in terms of using the Shanghai Gold Exchange as a medium to do that. So these things are feasible for sure. Will you get widespread gold transactions? No. They will be selective. It may be that it's restricted to BRIC member countries. That's possible. But I think generally what you're looking at is a gold backing. I mean, a gold content backing, not clearly not one for one. But the fact that China is accumulating a lot of gold will give people a lot more confidence in the currency.
I do want to ask you forgiveness with the number of questions that I now have in the back of my head, knowing that this isn't, might be over my skis on this, but this is why I'm talking to you. And I've always appreciated the conversations that we've had over the years. But, one thing that you've always taught me is that the one thing when it comes to any monetary system that is out there, it's the foundation of it is always trust. And everybody has a distrust for almost every monetary system out there currently that's available, including the renminbi out of China. So are you saying potentially that it would take the backing or some sort of influence using a physical base of gold to provide some sort of foundation for a future monetary system out of China to provide a little bit more trust for global usage?
Yes, I think absolutely right. I mean, every financial system needs some sort of collateral backing. We've got to think about what that collateral backing is. Now, if you go back to the 19th century, the collateral backing in terms of the UK, the British system was a gold standard. Okay, it wasn't one for one, but basically the way that the gold standard operated in the UK was that monetary policy was really a slave to those capital flows or trade flows. So if there was an outflow of money, interest rates were raised, etc. So that was a pure operating gold standard. We don't have that luxury now because we have big states, and big states need financing, and the financing requires essentially a fiat monetary system. The question is really one of degree. If you look at the dollar system at the moment, the collateral in the dollar system is the US Treasury market. The problem the US Treasury market has got is that the deficit is exploding. It will continue to grow. And the debt-GDP ratio in the US is going to skyrocket. Now, as a heads up, let me just give you some numbers. It looks as if the structural deficit in the US, the structural fiscal deficit, is likely to be something like 8%, maybe higher, of GDP. And those figures come from extrapolations using data from the Congressional Budget Office, which is a bipartisan body. So it's essentially broadly neutral, independent. The Congressional Budget Office looks at four major areas of growth. And those areas of growth are Social Security, Medicare, the interest bill, and defense. Now, the only change in the numbers that the CBO give and what we project is that we've taken defense spending to move up to 5% of GDP, which is the NATO target. We assume that's probably a more realistic figure than they've penciled in. And that gives you a whopping great structural deficit. There is no discretionary spending in those figures at all. So this is purely the structural factor. In other words, what is committed, what has to be committed. And that is a large chunk of GDP every year to fork out. It looks like the debt-GDP ratio under that regime will move up from just above 100% now to about 250% by 2050. Whoa. So you're looking at a huge increase. I mean, this is like Japan-like numbers, okay? Japan survived. Let's not say there's any threat to the integrity of the US, but the question is, how is that funded? And that's really a question. Now, if you look at the deficit, or the debt pile, I should say, and you said, let's think about that debt pile being constant in gold terms. What would the gold price have to be if the debt-GDP ratio rose at that clip? And the answer would be that the gold price in the mid-2030s would be something like somewhere between $10,000 and $15,000 an ounce. And if you go to 2050, you're talking about $25,000 an ounce. Now, people will sit here and think, wow, that is fanciful, okay? But let me just give you these figures. In year 2000, compared to today, the federal debt was 1/10 of today's figure, which is today it's about 29 trillion in terms of marketable debt in the hands of the private sector, okay? So in year 2000, 25 years ago, it was a tenth. So it's increased tenfold since then, 10 times, okay? How much has the S&P gone up over that period? The answer is less than 5 times. How much has gold gone up over that period? 13 times. So the fact is that the gold market has kept pace, more than kept pace, with the size of federal debt in the US. And That should be an eye-opener or a way of judging a benchmark to what is going to happen in the future.
Incredible figures you just pointed out here. And a lot of the conversations that we've been having throughout this week here in London is, we can call it a capital wars or trade wars. But when we focus on U.S. supply chains, and I've posed this question yesterday in a separate discussion, but I said we quickly went from reshoring of supply chains to remilitarizing awfully quickly. And we have seen money being spent by the U.S. government to do those things, Department of Defense or Department of War, taking allocations of specific companies in the name of resupplying rare earths, critical minerals, even taking equity stake. But we also know that it's just a dime in the bucket and that a lot needs to be done if we are certainly going to bring in a lot of that natural resources to resupply. Now, given what you just said, my follow-up question is it just does not sound like we can even merely afford to do it if this is the path that we're going down to make sure that we achieve those goals. And maybe are you being almost too conservative with the debt, federal debt moving forward, if this is exactly what's going to do? Because if the only game in town is for the U.S. government to come in and spend the money to reshore and remanufacture and remilitarize, it almost sounds like those numbers are a little too small.
That's entirely possible, for sure. As I said, we incorporated 5% of GDP on defense. It clearly could be higher. If it goes into a war situation, clearly it will be. Yeah. But at the moment, you've got to use best guesses, and this is what we're suggesting. That, even having said that, a 5% figure still gets you up to a gold price of, significantly 3 times where we are now, at least 3 times over the next 10 years.
But you can't expect the gold price to make that move within the next year. So if we're sitting here, we're December contract hit $4,200 an ounce this morning, as you and I are talking. Is gold appropriately valued today or no?
You mean, is it a fair value or is it a fair value?
Is it a fair value?
Well, I think the thing is that you've got to look at it relative to I think you've got to think about the trend and you've got to look at the cycle in these things. Everything we look at tells us the trend in gold is going upwards. Now, we can sort of dance on the head of a pin and try and say, well, okay, how is the cycle going to move? Gold is a fast trading commodity, and it will go up and it will go down. Markets never go in straight lines, of course, so you've got to expect that. But one of the things that will affect the gold price at the current time or in the short term is what the Federal Reserve or what the People's Bank of China are doing in terms of monetary policy. Now, therein lies a tale or two. The first thing to say is, what is China doing right now? And in terms of what China is doing, China is expanding liquidity quite aggressively. And they're doing this for the first time in many years. They started at the beginning of this year by injecting something like $1 trillion into their monetary system. Okay. What has prompted them to do that? Well, we know that the Chinese economy was pretty sluggish, that's for sure. But ultimately, what they've got to do is they've got to get their debt problem cured. Mm-hmm. And rather like Japan 15 years ago, China has this whopping great debt problem that it needs to somehow erode. Okay, we've got empty buildings, prices of residential housing very depressed and probably still falling. And these are elements that are not viable in an economy that needs to be dynamic, and particularly if they're facing ultimately a military threat or certainly a capital war vis-a-vis the US. So they've got to get their financial system in better shape. And the way that you do that is to try and eliminate debt by monetizing that debt. And that has been every example of every country that's had a debt problem through history has monetized it away. Okay, mm-hmm. You simply cannot default that degree of debt because the credit systems depend on debt. So you need to monetize away, print money, in other words. China's embarked on that particular route. And what you're seeing is the evidence of that very clearly in the markets. Okay, what are you seeing in terms of number one, the stock market? It's soaring. Okay. More liquidity going into Chinese stocks, prices go up. What's happening to the bond market? Yields are rising. Again, that's what you'd expect if you've got a lot of liquidity going into the market. The bond market will sell off. Okay, term premia to be wonkish will start to rise in bonds, and they are in China. And thirdly, what happens to the yuan currency? It devalues. Well, I would argue, don't look at the dollar yuan cross, look at the yuan gold price, because that's really what they're targeting. And what they would want is the yuan to go up in gold terms. And we made a statement last year to say that if China wanted to scratch the surface, only scratch the surface of its debt problems, it would have to let the yuan devalue to 24,000 yuan per ounce. Okay, that would be the minimum level. It's just in the last 2 months, easily surpassed that now. It's rocketing higher through 24,000 and climbing. And what they're doing is they're purposefully devaluing the yuan. Now, at the same time, China is accumulating gold. So it's, if you like, facilitating that devaluation from the other side too. But ultimately, what that means is that they get paper assets devalued against real assets in the economy. So what you should begin to see now is the first evidence of that in terms of real prices. Things like real estate should be starting to bottom out at least. We know the stock market is starting to lift off. That's a pretty encouraging sign. So China is basically beginning this process of reliquefaction of its markets, monetization of its debt to try and get its financial system in shape. So I think it can withstand, or it can be more robust and withstand the challenge of the US. Now, what is the challenge of the US? And let's get back to what the US is doing.
Yeah, I was going to say, because some of that you could have replaced China with the US, and it was almost replicable until the later half. That's where things kind of diverge.
These are similar economic structures.
Yes,
okay.
Yes.
These are state-dominated economies, and increasingly in the US government is actually directing spending. Now, therein sort of lies the second part of the story. What the US seems to be doing in terms of our interpretation is they're shifting away from what might be called Fed QE, in other words, using the Federal Reserve and the Federal Reserve balance sheet to essentially inject funds into the economy. And that was really a recipe that was used after the global financial crisis and after the COVID crisis. Federal Reserve was very active, in terms of balance sheet expansion. So they're replacing that with what we call Treasury QE. Now, that may be a slightly odd or slightly wonkish concept, but what that really means is using the bill market, the Treasury bill market, to fund government spending. So there's tremendous issuance of bills. This is actually what Janet Yellen tried some years ago, which we sort of called flippantly then Yellenomics. So it was basically using bills to finance government spending.
The front end.
Yeah. Why is that so important? Because basically, it's very easy to sell. There's huge appetite for the front end of the market, front end of the curve. Banks love this stuff. And if you've got a loose fiscal policy whereby the government is writing checks and bank deposits are building up because of those checks that are coming in from the US Treasury, the banks want another asset on the other side of their balance sheet that will effectively match, and more particularly duration match, those liabilities.
Yeah.
So short-dated government debt is excellent for that job, and therefore they're ready buyers. The problem is that if a credit provider buys government debt, that is monetization of the deficit, and that is what's going on. So effectively, the US government is, printing money indirectly, but it's printing money to finance fiscal spending. And that fiscal spending is being directed into the real economy, whether it's buying strategic stakes in critical minerals or technology companies, or whether it's essentially investing via defense contracts. You name it. This is the directed spending that the U.S. government is currently undertaking.
I want to ask you about the purchases or the supply of the short dated bonds, because for number of years, we've talked to a number of people when Janet Yellen was issuing a lot of short-term bills. I mean, I would have people on this podcast call it criminal, maybe even go to an extent to where they felt it was, not the right thing to do. Besant comes in, makes a promise during the campaign that was not what they should do, and they need to focus on the long end. But it was a quick pivot, and we don't hear anything about that. And almost, as you mentioned, it sounds like they're back to doing exactly what Janet Yellen did. during a 4-year term as Treasury Secretary, but you don't hear the complaining.
Yeah, exactly. I mean, they realize this is the only route they've got, so that's going on now. Out of thin air, there's a sort of I don't know about magic money tree that's being created, which is called stablecoin.
Yeah.
And stablecoin is something which is being promoted actively, and I think stablecoin are a huge or have huge potential in the world economy for a number of reasons. I mean, number one is it provides another funding source for the U.S. government. They are clearly a route into buying other crypto, such as Bitcoin. So there's going to be demand for this stuff generally. But I think more particularly, you've got to look at it outside of the US. What does the stablecoin industry really mean for potentially non-US holders? And then let's start thinking about China. Now, I think stablecoin pose a big threat to other financial systems. I mean, the Europeans are clearly worried, but China is really in the sights, I would think, of US thinking here. And if you've got a Chinese exporter who is accumulating dollars, they've got a choice. They can basically convert those dollars into yuan. They can hold those dollars in a Chinese bank on shore. They can basically hold it offshore in a Western bank. Now, those are not really attractive choices, because if they hold it in a Western bank and tensions increase, those assets could be sequestrated. And we saw that clearly in the case of Russia after the Ukraine invasion. Equally, you might say that if they put them domestically in a domestic bank, whether in dollars or in yuan, they could equally be held or sequestrated by the Chinese state if the exporter fell foul of the authorities. So these are risks. But if they hold a stable coin, that may give them an option, which is a much lower risk financial instrument to hold. The trouble is, if they start to put more and more of their money in stablecoin, the Chinese authorities lose control of their monetary system increasingly. And therefore, this is a direct threat. And that's why I think the argument is that that's why they need to get their financial system made more robust in the short term, which really means injecting liquidity, getting rid of the debt problem, elevating the gold price. And if China is accumulating lots of gold while the price is going up, they're in a sort of win-win situation.
Yeah. Do stable coins pose a threat to the U.S. monetary system as you see it? So a similar fashion that you just described with China?
Well, I think they may.
It seems a little bit more adoptable in the U.S. Like,
Yeah, I
people
think
are accepting of it.
I think it may be challenging for banks in terms of their existing product range. I mean, that's for sure. It will take business away from banks. It will take business away from money market funds. But I think in the case of the US, if they embrace that, it isn't necessarily such a bad thing. It's probably for the US, it could easily be a win-win if it's properly regulated. And that seems to be where the efforts are currently being spilled. So they're trying to make a decent architecture or infrastructure around stablecoin.
Would stable coins from private institutions and the likes of Tether be accepted by the United States government as a new monetary system, or do you feel it would have to be brought in, developed, and launched by the Treasury itself?
No, I think it's more or less been ruled out that the Treasury would, or the Fed would now go into to create a digital coin. So it's really been left to the private sector. The interesting question is what would happen if if you saw a proliferation of many different stable coins. I mean, that's clearly fragmenting the system is potentially dangerous. And it may well be that what the authorities want to encourage by hook or by crook is you just get a very small number of major stablecoin issuers. I mean, that's possible. And if you got a situation where there was a problem in a major stablecoin issuer, then I think it would be almost certain, or let's say highly likely, that the US Treasury would bail them out in some form. They'd have to, because it would be such an integral part of the US monetary system.
They would be too big to fail.
Too big to fail, yeah.
Amazing. Man. I have a real disgruntled view of, we've been hearing about it, US backed digital currency or token or whatever, for many years. And I've always just kind of felt we're already there. It's called the US dollar. And here's a great example. I have So I needed some cash, and this was a number of months ago. I needed some cash, actual greenbacks to pay for something. I think for like one of my kids' birthday parties or something. Put some cash in a birthday card. And remember, I took out $100, so I had five 20s in my wallet. And this was probably 2 months ago. To this day, I still have two $20 bills in my wallet that I just never really have use for because I'm always using the transaction with my credit card, tapping and going Apple Pay. And so the US dollar, in my mind, has already turned into a digital currency. We just don't use bills. Nobody accepts them. Like there's places in Colorado that literally will not accept cash. Although you can have the philosophical discussion, well, cash is still legal tender and you have to accept it anyways. They're not going to accept it, and it's not worth the time to battle them, at the counter over your pint. You just tap and go, And so my position has always been, we already have a digital currency. It's bought by Visa, MasterCard, Discovery. It's tap and go, Apple Pay. We're already there.
The question is though that if you look at the comparison between holding a paper bill and holding money electronically in a bank, and I take your point entirely, one is traceable and one isn't. And the fact is that if you want to be anonymous, you need the paper bill, or you probably need a stable coin, on the assumption that stable coin is untraceable.
But the government wouldn't want it untraceable. They would want
some sort of tracking.
Yeah.
But the question is that is it safer to hold a stable coin electronically through a stable coin custodian than it is holding it in a Western bank?
Yeah.
And that may be the question that's an unanswerable.
What's your opinion on that question?
I think it's a grey area, but I think at the moment as we stand, it probably is. Yeah.
Yeah.
It would be a lot more difficult to sanction that. I'm not saying it's impossible, but it would be difficult.
Yeah. I mean, you and I have differing opinions on cryptocurrencies, and especially Bitcoin. And I tweeted out the other day, over the weekend, Bitcoin got hammered pretty low, and there was a lot of liquidity. A lot of people lost a lot of money in their Bitcoin holdings. And I had posted something like, in my opinion, it's always been a great trading vehicle. Like if you're ready to go in and out with Bitcoin and trade it, have at it. I do find it incredibly dangerous to quote unquote hodl the thing. But to its credit, it's done an incredibly great job of teaching masses the dangers of fiat currency. I will give it that. But in the back of my mind, Mike, I'm just kind of like, you're telling me this algorithm, this code was written by somebody who remains anonymous, and it has just driven so much capital, so much liquidity into it. What if, and I know this is all incredibly kind of tin hat-ish and conspiratorial to say, but what if it was just another weaponized tool by a foreign adversary to do exactly that?
Right.
Suck in liquidity.
And we don't know.
To a point where now's the time.
Mr. Satoshi is actually a Chinese agent, or whatever it may be. Who knows? Yeah.
Is it a 0% chance that Satoshi is?
Well, I don't know. I suppose stranger things have happened, haven't they? So,
And I'm not trying to spread conspiratorial. I'm literally just saying I've spent a lot of time thinking about this.
I think the thing is that, one can never really pass judgment on that. it seems unlikely. And, a lot of people have looked very closely at what goes on. So they seem to assure me that, Bitcoin is kind of unbreakable and it's a robust system and whatever. And my expertise doesn't stretch that far. So I don't know. I've got to take it on faith. But I think if you look at the performance, it's very interesting to look statistically at the performance of Bitcoin, and particularly Bitcoin versus gold. And we've actually spent quite a lot of time of digging deeply into the data and looking at weekly movements in Bitcoin, gold, and our measures of liquidity. And actually what you find is a sort of an interesting conclusion in a way. And this is looking at data, probably 10 years of weekly data. And it's broadly consistent over that whole time frame. And what it says is about half the movements, this is the systematic movements, because clearly there's noise we've got to take out, but about half the systematic movements in Bitcoin come from liquidity factors. In other words, movements in global liquidity, whether it's the Fed, whether it's the People's Bank of China, whether it's the ECB or whatever. These central banks matter hugely to the Bitcoin price. So your point about this is a monetary a debasement trade, absolutely correct. This is what's going on. Okay, it's not only trend; it's cyclical too. The second element that comes into the equation is investor sentiment, risk appetite.
Yeah.
So things like what's happening to the Nasdaq market will actually clearly influence what's happening to Bitcoin. That's about 25%, and the other 25% is the gold price. So Bitcoin tends to move with gold. Now, the interesting element in that is if you then dig even deeper into that relationship, what you find is that in the short term, Bitcoin and gold tend to be negatively correlated. Okay. So in other words, if the Bitcoin price goes up, gold tends to go down. If the gold price goes up, Bitcoin tends to go down in the very short term. And that suggests there's an arbitrage going on. But in the long term, they're very positively correlated. So Bitcoin's trend and gold's trend pretty much run together.
But Bitcoin continues to be somewhat of a proxy to U.S. equities, specifically tech.
Yeah, that's the risk appetite element
Yeah.
that is not in the gold equation.
Yeah.
So you've got a mixer. So in other words, what this is really saying is that, put it another way, again, sort of maybe somewhat crudely, maybe Bitcoin is something like 2/3 commodity and 1/3 tech stock.
Okay. All right. I wasn't necessarily prepared to go down the rabbit hole of Bitcoin, but I'm glad we could cover it. I want to get back to the gold market here. And I know you watch this thing real closely. How do you kind of, if you kind of wrap up the 22 hours of trading of the gold market per day, we can see fluctuations. And if you start in the East and specifically Asia demand, move into Europe and London, and then finish the day in Western buying, like how do you, are there similarities or are there differences? And, is there certain trends you're picking up, in those hours of the day in the gold market?
Well, my view would be generally that China or Asia is driving the gold price and the West are reacting to it. So I think that all the momentum or the bulk of the momentum is coming from the East, from China. And, one of the things that's lifted the gold price in the last 12 months, well, in fact, there have been two factors, in my view, two marginal factors that are different. One is that China has been a very aggressive buyer of gold. So they bought, what was it last year? Maybe 750 tons of gold. Huge amount, that's twice their annual production, if my memory serves me. So China's a big buyer of gold, physical gold. And the second thing is that the People's Bank of China has been printing money. So they've been very aggressive in terms of their liquidity injections. So they've injected around $1 trillion into their monetary system this year. Sizable amount of cash. Put that in context, the US did about $2.5 trillion after the global financial crisis. Now, China's going down that same road, so China's probably going to do the same again, but you get the idea. China is actually pushing up the gold price significantly. And I think the West is kind of reacting to that. So I think the gold market is really being set in Asia, and it's being copied in London. Now, that may be a point of a lot of debate. People would disagree with that because London's a bigger market, but actually the physical market is the Shanghai market, and that's really what's important right now. I think the other thing to say is that you've also got to bear in mind that the US is, of course, monetizing debt as we speak, and that's clearly giving a further impetus. So it's not purely the Chinese that are driving this. You've got the two major engines of the world economy, China and the US, which are basically monetizing right now. And that printing of money, as we know, always leads to a rising gold price. Or actually, what we should be really saying, of course, is that the gold price stays where it is in real terms, but it's paper money that's devaluing against gold. It's just the way we express it, the other way around.
Yeah, that seems like the path that the U.S. is certainly heading. I mean, President Trump has not been shy away to say he wants a weaker dollar, he wants lower interest rates. And in fact, we've seen the moves of putting his people into positions that can help move the policy in that direction. And the conversations I've had in a couple of weeks, Mike, and when I hear it, I always kind of think back to discussions I've had with you regarding yield curve control. And it's always been kind of an if situation, but now lately it's almost that if has turned into a when.
Yeah.
And all will, be dictated on the move out of the bond market when, the bond market has a decision that says enough is enough. There's just too much going on. Yields start rising, they lose control, and all of a sudden the Federal Reserve has to come in and backstop the yields with yield curve control.
Exactly. But you see what they're doing now is there is yield curve control going on as we speak. And you can see that very clearly is if you bootstrap an equivalent treasury yield from the mortgage market. The mortgage market is a government-backed market. It's a risk-free market. It's equivalent to treasuries. Central banks own mortgage-backed securities, US mortgage-backed securities. The only difference is that mortgage-backed securities are longer duration and they have what bond people call more convexity. Now, you can make those adjustments mathematically and get back to, you can bootstrap, therefore, a 10-year treasury equivalent from the mortgage market. And if you look at that, the difference is about something like 70 to, it varies between about 70 and 100 basis points. So in other words, treasury yields are already being depressed. And why are they being depressed? Because issuance has been skewed to the front end, to bills, and away from coupons where they're creating a scarcity. And that scarcity of coupons is what's pushing down the long end of the market. So yields would be higher in a normal issuance calendar.
Yeah.
So that's happening. The other thing that's going on is take a look at volatility in the bond markets. That is being suppressed. So the MOVE index, which is a measure of bond market volatility, has basically skidded lower over the last 12 months. And that's important because low volatility is critical to maintaining demand for treasuries from hedge funds because they're engaged in this basis trade. So in the absence of Chinese buyers of US treasuries, who have clearly gone to sleep now, the marginal buyer tends to be the US private sector in the form of hedge funds, and those hedge funds demand low volatility. And that is what the Treasury seems to be giving them right now, until they don't. And the problem that I think is building up, which comes onto a very short-term view, but if you look at what's happening in the US repo markets, which are really where you get interest rates being set at the short end of the market, those repo markets are coming under strain. And they're coming under strain because what the government is doing in the US is shifting, if you like, the hose away from, it's grabbing the hose from the Federal Reserve, and that hose has been sort of washing everybody with liquidity and everything's been going up, the everything bubble, of course. And they're grabbing that hose and they're focusing it, they being the Treasury, they're focusing on the real economy. So they're shifting from Fed QE to Treasury QE. They're pushing money into real things, okay? And as a result of that, financial markets are losing liquidity. And that is being expressed in the repo markets, where you're starting to see spreads jumping up vis-a-vis Fed funds targets. And that can't sustain itself. So what you're beginning to see in the fixed income markets as a result is an increase in trade fails. And that is a warning sign that more volatility may be coming down the pipe.
Did we see the same sort of movement in headlines in the repo market in the winter of 2019
Correct.
into the spring of 2020, right
Correct.
before COVID?
Correct.
So this is almost a replica.
It could be a mini repo crisis underway. Now, the Fed would believe, with some good reason, that they have control over that because they've now got a standing repo facility where if there are problems, effectively dealer banks can go to the Fed and actually borrow against collateral. But as we know, so often they've had a discount window forever, and you still get financial crises. So never say never. And if you look at the tensions in the market, clearly they're live. You wouldn't get an increase in trade fails in the system if that wasn't true.
Yeah, it feels like we are approaching. I mean, and just probably just a quote fourth turning type stuff because it certainly feels like that's where we're at, but we're almost to a point where it's the climax to a crisis. Is that fair to say? How do you feel when you hear that statement, just watching markets and the movement of capital around the world? Does it feel like things are about to boil over, or are you more optimistic?
Well, I think it depends in which direction one looks. I think in terms of the real economy, looking into 2026, I'd be more optimistic. okay,
Okay.
of the US real economy, because I think that, barring a major slide in the indexes, where there would be a negative wealth effect that could impair consumer spending, I think the fact is you've got a lot of capex going on, particularly through AI related, which is running at about, a billion a day or whatever the astounding numbers are. But this is big stuff. And on top of that, you've got government spending, which is continuing to roll on. Government defense procurement et al. Is a significant source of cash. So I think you've got this impetus going into the economy, which probably will lift growth through 2026. Now, I'm not saying the economy isn't slowing down now. There may be a bit of a hiccup going on. That's understandable. But the question is, financial markets always look forward, and they may well have already discounted this slowdown, and they're starting to look beyond. They need to start looking beyond that. Now, the point is that strong economies don't always have strong financial markets. And that's really the thing to remember. The two don't really go hand in hand. And what we need to think about is what type of assets will benefit from a stronger economy maybe in the middle of next year. And it may be a stronger world economy because China is doing much the same. And our view is you've got to start moving towards commodities. And I think that's true for a strategic and a cyclical reason.
Okay, so you mentioned commodities. Do you feel like we're in the beginning innings of a true commodity cycle?
I think for a number of reasons we probably are. I think strategically we are, because basically if this is some sort of capital war or more general kinetic war, I mean, if that ever transpires, I doubt if it will, but I think we're in a regime where governments need to control resources, that's for sure. So you're going to have a lot of capital being pushed into this area, and I think that commodity prices inevitably will start to go up. You've got to have new supply chains.
I mean, the commodity market alone is done really, really well, and what's completely baffling to me is that it's done so without the help of the largest commodity market, oil.
Yeah.
It's in the tank.
Yeah.
And nobody wants to touch it because the prices are just so depressed. And, I mean, this is probably, the contrarian. And now that I say that out loud, the contrarian me is like, oh, maybe you should start looking at it now that you're, bottoming your hopes here. But this commodity cycle right now, where would it be if it had an oil market to lift it up?
I think it's a fair point. But I mean, the fact is that oil is a political commodity. And it may well be that most of the price setters of oil are in Trump's pocket. So it looks that way because oil prices are being conveniently held down, which is a great spur to lower inflation in the US.
Yeah.
And if you look at every financial crisis in recent years, what has triggered it or what has been associated with it, trigger is a dangerous word, but what's been associated with it is sky-high oil prices. And we're not getting that this time.
No. It has also been the agriculture market in the U.S. is really getting hit really hard. Unless you're a cattle rancher. I mean, beef prices are going to an all-time high. It seems like every day. But if you're a farmer, corn or soybeans, you are really struggling here, which is pretty amazing. Not a single contract shipment to China has left the U.S. ports this year, soybeans, which is it's crazy. So again, oil, agriculture, where would we be if those two markets were on its appropriate footing?
Yeah,
it'd be fascinating. All right, Mike, I've taken up a lot of your time. I really appreciate you welcoming to your office. Thank you so much. Yeah, I didn't know quite what to expect, but I'm glad we can make it happen. Maybe again, I'm sure everybody can find you where they can find you, but why don't you let us know like the most appropriate places?
Well, I think the most straightforward place is on Substack. Which is our Substack called Capital Wars, appropriately, which is named after the book I read a few years ago about this coming conflict. Yeah, okay. It's a great book. You must have it. And maybe a new edition? Well, people keep saying that. But the last one was, it took so long. I don't know. I aged 10 years. All right, buddy. All right, good to see you. Thanks, man. Great, thanks. The information presented should not be considered investment advice. Mining Stock Daily and its affiliates are not responsible for any loss arising from any investment decision in connection with the material presented herein. Please do your own research or speak with a licensed financial representative before making any investment decisions.